Gold is approaching a major liquidity zone right now, and smart money is quietly preparing its next move. We're not looking at retail support and resistance today. We are hunting pure institutional order flow. Let's get straight to it. My primary focus today is a potential long setup, and the absolute draw on liquidity is the 4165 buy-side liquidity target. We're maintaining a firm bullish bias on the higher timeframes. That 4165 level, it's acting as a massive algorithmic magnet, drawing price right toward it. Before we even break down the institutional reasoning, here is the precise executable trade plan. I want you to see the exact outcome we're hunting. We're looking to position long. Our primary entry zone rests down in the discount area between 4112 and 4118, keeping our structural stop loss safely anchored below at 4098. Take profit 1 sits at the session high of 4140, and we leave a runner for that 4165 buy-side target. That gives us a highly asymmetrical risk-to-reward ratio of 1 to 3.5. But here's the problem. What actually needs to happen before smart money executes this buy program? Because despite this incredibly clean bullish bias, there is one critical condition that most retail traders are entirely missing right now. The market is flashing a warning signal, and if you jump in too early, you're just going to become the liquidity. To understand the timing here, we have to look at the fundamental volatility catalyst. Geopolitical tensions in the Middle East are escalating. We're seeing reports of U.S. forces engaging targets, and Iran's foreign ministry explicitly stating that any aggression will force a definitive response. Add to that, Iran-backed Houthi forces have reportedly struck 2 Saudi tankers in the Red Sea. Now, as analysts, we observe these events completely neutrally. We're just looking to understand exactly where the market's explosive energy is going to come from. You see, institutions utilize these exact macro events to engineer massive liquidity traps. Take a look at the pre-news market. It deliberately compresses, building up weak sell-side liquidity. Basically, a giant resting pool of retail stop losses. Then comes post-news, with the high-impact U.S. unemployment claims dropping in the New York kill zone at 7:30 p.m., right alongside those geopolitical catalysts. Expect a massive volatility injection. Smart money will use this news-driven chaos to aggressively sweep the lows, grab that liquidity, and then immediately displace higher. Let's validate this from the top down. Looking at the daily time frame, you can see smart money completed a higher time frame liquidity sweep right down at the 3950 support floor. After purging those protected lows and clearing out the early buyers, they established a really strong reversal leg. Price is now actively expanding upward toward unmitigated premium arrays. Those are the older areas of supply that just haven't been retested yet. The macro footprint here is undeniably bullish. Dropping down, the 4-hour order flow confirms this macro recovery perfectly. We've got a clear sequence breaking that key 4080 structural swing, which shifts the momentum entirely. Just look at the massive displacement candles pushing through those levels. Listen, that is not retail buying pressure. That is the unmistakable signature of dominant institutional buy-side control actively expanding towards the 4160 zone. Now focus your attention on the 1-hour dealing range. Price is currently consolidating near 4126, and I promise you, this is not random noise. The algorithmic market makers are deliberately pausing right here in a premium zone to engineer internal sell-side liquidity. They are literally manufacturing a pool of retail sell stops right below the current consolidation. They're priming the market for its next explosive markup phase. And that brings us to the exact institutional target attack order. Here's how it plays out. Step 1. They target that internal sell-side liquidity resting between 4115 and 4118, pairing their massive buy orders with retail sell stops. Step 2, we see violent upward displacement. Step 3, they launch a direct attack on our primary objective, the 4165 buy-side liquidity pool. And finally, Step 4, continuation up toward the 4200 higher timeframe premium array. So, with all this bullish confluence aligning perfectly, you might be asking the most important question. Is it time to hit the buy button and enter the trade right now? The answer is absolutely not. No trade. Smart money confirmation has not yet appeared. Look, entering right now at 4126, right in the middle of this range, is a purely emotional execution. As professional traders, we demand absolute precision. And right now, the conditions for a high-probability entry simply do not exist. The granular 15-minute price action shows you exactly why. The market is just oscillating mid-range without a valid institutional footprint. We haven't reached our discount arrays yet, and that 4115 to 4118 sell-side liquidity cluster, all those resting stop losses, it remains completely unpurged. Until that specific liquidity is swept out, we are sitting on our hands. Here is the strict, four-step execution model that must trigger, ideally during the New York session volatility injection, for this setup to actually become valid. First, we must see a definitive sweep of the sell-side liquidity at 41.15 to 41.18. Second, we need an immediate 15-minute market structure shift to the upside. Third, this shift has to be characterized by strong bullish displacement candles. And fourth, we execute our entry on the pullback into the newly formed 15-minute fair value gap. That's the algorithmic void left behind by that sudden burst in price. This leads us to a crucial element of institutional trading. If you want to trade with smart money, you need to know exactly where the retail money is about to be slaughtered. So, where are retail traders going to get trapped today? This is the scenario most traders are completely ignoring. First, impatient traders are buying early right now, right in the mid-range at 41.26. And where are they placing their stop losses? Exactly at 41.15, the precise level institutions are targeting for their liquidity sweep. Next, the breakout traders will see that drop into 41.15, assume the market is crashing, short the breakdown, and instantly get caught in the aggressive reversal. By completely ignoring the higher timeframe bullish order flow, retail becomes the liquidity fuel. Of course, we must always anchor our analysis in objective risk management. This entire bullish thesis has a hard invalidation level, a sustained 1-hour candle close, and I mean a definitive structural close, not just a wick, below 40.75 completely destroys the immediate bullish intraday structure. If that happens, the setup is dead. We don't guess in this business, we follow the structure. Let's lock in this data with a rapid final recap. Our directional bias is solidly bullish. We're waiting for price to drop into our entry target zone of 41.12 to 41.18, but only after a liquidity sweep. Our strict structural invalidation rests at 40.75, and our final objective, the ultimate draw on liquidity, is the 41.65 buy-side target. If you enjoy institutional-style market analysis using ICT and smart money concepts, consider applying these methodologies to your own charts. And if you'd like to trade alongside setups like this in a professional environment, you can find the FXTM account link in the pinned comment below this explainer. The roadmap is laid out perfectly, but the ultimate question remains. Do you have the unshakable discipline to sit on your hands and wait for the sweep, or are you going to become the liquidity?